Well, Josh, where are you, my friend?
I am at the home office trying to keep things straight.
Well, hey guys, welcome back. Jeb Smith, Josh Lewis, both here in Southern California, real estate broker and a mortgage professional here to guide you through the real estate market, answer any questions you have about what's going on, anything we can do to help guide you in the right direction. Josh is actually joining us. He has been down for the count for about 2 weeks now. He's actually taken some time from his nap to join us on a call tonight. So you guys give Josh some well wishes, sending some prayers, some positive vibes, and maybe some hydrochloric, whatever that is, and maybe you'll clear up here soon.
I think that it's the remdesivir or there's another one that's supposed to actually work. The hydroxychloroquine was a myth.
Yeah, there you go. So anyway, I appreciate you being here. So Josh, may or may not be with us the entire time. Hell, I may not be with us the entire time. Last week, I have to apologize. My mind was in the gutter during the entire episode. I was thinking about something else, trying to get deals straight and that sort of thing. And I don't feel like I was there and provided a lot of value, but I appreciate you guys sticking through it and hanging in there with us. But we're going to get to some questions tonight. We do have some some late reports on, California statistics, that sort of thing. We've already got questions about people asking about the rental payment, which I know you have an opinion on there, Josh, as well. We have Jennifer here moderating the chat. So thank you for being with us, Jennifer, as always. But Josh, anything you want to start with today? Anything on your mind that we can actually put out there?
We're in the dog days of summer here. There's nothing interesting happening. Rates just continue to kind of chop back and forth in the same nice low range, which is good. It's good to not have any stress. Market, you and I have talked about this. People worried and stressed, but the market is still busy in terms of our buyers having to compete against other offers, but at the same time, it's not crazy like it was in the spring. So we're kind of into a more reasonable, more enjoyable market where rates are still low, people are still qualifying and not having to write 52 offers against 100 competitive bids. So other than a little summer illness here, life is good.
And still a lot of agents out there that have no idea what they're doing listing homes for sale. I'm going to start today by telling you what an agent asked me yesterday, just so everybody watching this has an idea of who you're dealing with out there in the real estate market and who might be on the other side of a transaction. Hell, they might be representing you. So I submitted an offer on a property. And it was a counteroffer situation, blah, blah, blah. We ended up countering back and what have you. The agent called me and asked me if she had accepted an offer already, could she cancel that offer and accept ours after everything had been signed? And I was like, really? This is the agent that's on the other side of the transaction here. She's asking me if she can cancel her other offer she accepted and now accept ours. So people, deal with professionals. I preach it all the time. Not to say that she's not going to do a good job for a client, but at the end of the day, you should know what you're talking about when, that's not the kinds of questions you want to hear from the agent on the other side of the transaction when you're going into escrow. But nevertheless, I will move along here. We got a question from Michael Dury to start here, Josh. And his comment is that he knows that the market will never go back to normal. And I think that is, there's that new statement, the new normal and all this stuff, which I'm not going to get into, but get back to normal. But when it does correct, will the buyers that paid $50,000 or $100,000 over asking be upside down? So I'm going to throw that to you just to start and get your thoughts on, how you would answer that.
Back in 2005, 2006, 2007, there was a couple of things that people like to fall back on. They like to say home prices have never fallen year over year on a national basis, to which we always said, so what? It has in my market, so I don't care what the national averages are. But one of the things that they had mentioned, which is true, is that home prices are sticky to the upside, and there's a reason for that. When home prices go up, so let's say I haven't sold my home, but let's say my neighbor sells for a really high price. I'm going to have psychologically a really hard time putting my house on the market next year and asking less than what they said. So people are more likely to not sell their home than to let it go for less than what their neighbor sold for. So we've talked about, we have a supply demand imbalance, more people wanting to buy homes than a supply of homes for sale. And when people put the home on the market, they're highly averse to taking less than the last sale. They're more likely to not sell their home than to sell for less. So is anything possible? Yeah, anything's possible. But $50,000 to $100,000 upside down when we're talking national average. What's the median now? Median home price 380, something like that nationwide.
Somewhere in that ballpark. Yep.
So it doesn't matter. Your neighborhood might be 700, it might be 200, but $50,000 on a 380 median, that's a 15% correction in prices. I don't see it happening. At some point, we will see some level of correction, but it's going to be from a higher price point, and it's unlikely to be that large of a correction. So could people be upside down because homes in their neighborhood sold for a ton more? Yeah, but it's highly unlikely. People don't sell for less than what they paid unless they absolutely positively have to. And the loan.
Yeah, no. I mean, you made a good point. Sorry to interrupt there, but I mean, you brought up a couple of thoughts on my side when you said that, right? You haven't actually gotten a loss on your house until you sell it, right? So even though it's $50,000 or $100,000 in this example upside down, you've lost nothing. Your mortgage payment is the same. Everything is the same on your house. Now, if you have to sell it, then you take a loss. Yes, I understand that. And like Josh said, some places when you say you're paying $50,000 to $100,000 over the asking price, I mean, again, a property is what someone's willing to pay for it. So are you the only one that was willing to pay that 50 or 100 K, or was there 50 offers and that's where the price led? So there's a lot of buyers that were potentially willing to pay that. And I think that's what you need to consider. The other thing that made me think of this, Josh, is like, think of the stock market. This is the mentality of the stock market is that somebody buys a stock, and let's just say it's Apple for our conversation here, and say they paid $150 a share for it today. Well, and they bought a bunch of shares. Well, if it goes down to 120 tomorrow, they don't automatically sell it. It's an emotional thing. They're attached to that stock. They're watching it. And guess what happens when it gets back to 150? They sell it, right? Because it's back to where they bought in. They feel safe. It's emotional. And guess what usually happens at that point? It continues to the upside. Those people miss out on that opportunity because it was fear-based, right? They were watching it continually. Once it got back to what they paid for it, they got out, the fear's gone, and things, I mean, whether or not the direction it moves after that's irrelevant, but it's that emotional piece of the puzzle that a lot of people don't factor in. And we talk about it all the time. People buy emotionally, they justify logically. And like Josh said, you have a home price, your neighbor sells for whatever, you think your home's nicer, better location, you've done some nice upgrades, whatever. You're not going to let your neighbor beat you out, right? I mean, you want your house to sell for at least that. And I think you're going to see a lot of that in this market moving forward, not anytime soon, but let's continue to move on here. We're going to answer this question in a minute, Jennifer, about the rental payments. Nathan makes a comment here. He's answering Michael's comment, basically saying, based on my latest video, they don't ever see a situation where this happens unless there's a catastrophe like 9/11. Now, that's putting words in my mouth that I do believe at some point prices are going to moderate. They are, right? We're already starting to see some moderation. But you understand where we're coming from, right? When you see now, and I've talked about this, and I talked about it in videos even today, is that when you see numbers decline, understand where they're declining from. You know, last year we had month over month appreciation that sometimes was 5% month over month. And even then, when you looked at the yearly numbers, it was a 20% jump in appreciation. So when you see the number of home sales or the amount of appreciation or whatever starts to decline, understand where it's declining from. That decline's actually a good thing to create a more balanced market. And again, a lot of you out there that watch this believe that us as real estate agents only want to see things go up. That's not true. We actually want to see more balance, because more balance offers more stability, which means that this, this whole thing isn't this big up and down deal, right? If we continue to see appreciation like we saw last year, 20% or whatever, that's not sustainable. That ends in major issues. Right now, we're not seeing that, right? We saw that big buy, that a lot of people purchase, right? Supply demand. That a lot of the fundamentals right there haven't changed, but you've seen a more moderating in it just because, we've talked about it. There were a lot of buyers at one time for a lot of different reasons. A lot of, a big portion of that's backed off. So now you're starting to see a more moderate market, more of what we would normally see. And because of that, you started to see a little bit of decline in some of these numbers, but that doesn't mean a shift. That doesn't mean that you're seeing a decline in prices or that the market dynamic as a whole is changing. But Josh, I mean, again, he mentions a catastrophe like 9/11. 9/11 didn't drop the house prices, right? I mean, that had nothing to do with the house prices. Where could you see, Josh, a moderation in home prices going forward from this point?
So, at risk of sounding like a broken record, everything comes back to being a supply and demand question. So, are we going to have a massive amount of supply come on the market? It's not going to be in the form of new construction because construction costs are high. They're not building primarily entry-level homes. They're building higher-end homes that have higher margins for them. So it's not going to come from a building additional supply. We've talked ad nauseum about, okay, forbearance ends. Isn't there going to be a big glut of supply if now people have to sell? No, not a significant volume. There will be some forced sales there, but not to a large degree. So what would change demand? One of the important things that we've always talked about is there is no limit of demand for homeowners. We talk about all the homeless people, all of the poor people. They would all be willing buyers of a home, but they're not able. So that's demand, but it's not able demand that can buy the home. So what happens when home prices go up, or if interest rates were to go up and home prices become less affordable? You have less able demand. So now you have that supply demand imbalance. Like the biggest threat to the housing market would be just more home price increases, where we end up with less and less of a percentage of the population that can afford to buy those homes. So are we there now? No. So if we were to hit that wall is at 20, 30, 40% higher prices than where we are right now. So I can't give you a measure or an event that would happen other than let's look, why did the market really slow down last March? It really just put the brakes on. We didn't have a lot of lower sales, but we had a stop to activity for about 6 weeks while people were looking and going, oh my God, what is COVID? What does it mean? Well, now we're sitting here, we had another outbreak in the winter, and we all thought by summer, hey, we're all good. And then now here we are with this Delta variant.
And now here you are.
Here we are with this Delta variant, and you're sitting here going, what if it never goes away? Or what if there's a bigger, crazier variant? I mean, the Delta is more transmissible, which is why more people are getting it, but it's less severe. So most people are like, well, hey, it's not fun, but it's not that bad. But if you had a newer, crazier variant that started killing people and we're locked down again and it shuts the economy down and all of the things that have been recovering over the last 18 months, if that was washed away, it could have an impact on home prices. That's really, probably the biggest or most likely thing that I would see. And I don't think it's likely. I think what we're likely to see is this thing mutate going forward and become more transmissible and less deadly. And it's just going to become a fact of life, and we're all getting used to it as much as it sucks.
No, and I was watching a video yesterday. One of my mentors, who's in the real estate space, on different levels, but Brian Buffini, right? And he's high net worth individual, and he actually talked about in his neighborhood how he's seeing luxury listings get purchased, and we're not talking like $1 million or $2 million. We're talking about high price listings here, $5-10 million in some cases, get purchased, and then they sit vacant. And so the question is, why are people, even at that level, people with a lot of cash, buying property and letting it sit vacant? It's because they're trying to, be somewhat risk averse, right? The stock market has done extremely well over the last 2 years or so. I mean, even longer than that, but really, really well over the last year. And if inflation is a real threat, this money is parking itself in a fixed asset, right? It's parking itself in a fixed asset that potentially they could maybe rent and guarantee the amount per month or whatever, but they're not even doing that. They're just letting it sit, vacant because they feel like their money is maybe more stable in that type of asset versus something that is a little more volatile. So, and most people that have that kind of money, that there's a lot of smart money in there. And that's why you see a lot of these funds, these hedge funds and these other types of companies buying real estate right now. And some of them buying it at levels and prices that are above what I think things are worth. And maybe it's a play against inflation. I don't know 100%, but there's a lot of money in the space and there's a lot of money sitting on the sidelines looking to purchase real estate. And therefore, to tell off what Josh said there, I don't see that, any increase in inventory isn't very likely, and any decrease in prices, probably that demand probably increases from the side of where that cash is sitting, just purchasing of that property. So, we talk about this again, we could beat it to death. And quite frankly, I feel like we do. But that's the thoughts at the moment. So Josh, let's go back up to that question. So last week, Fannie Mae came out, and was it Freddie Mac too, or just Fannie Mae?
Just Fannie, but
okay.
Usually it's just a matter of time. They do everything the same.
Okay, so Fannie Mae came out and essentially said that they were going to start factoring in rental payments. And we might have even talked about this last week, but not really in any detail, right? I actually think we did mention it, but I think since then there's been a little bit more detail on how they're going to factor in these payments. And so I think you're on the train that this really isn't going to do much of anything at all. But the idea is that allowing these people that have rental payments to be factored into their credit allows them to have more credit to potentially build a credit score, and gives them the opportunity to maybe have a potential to buy a house when they wouldn't otherwise. I mean, I don't know. I'll let you kind of jump down it and see get your thoughts.
It's another factor that desktop underwriter, Fannie Mae's automated underwriting system, can use to come to a comfort level and approve someone. So who are we talking about here? Who could benefit from this? Only people who couldn't be approved through DU or weren't getting approved through DU already. The second piece of it, they have to have a documentable and verifiable rent history. And the way they're doing this and pulling it in, because the algorithm, the automated underwriting system algorithm, needs to see it. The way they're doing it is you have to authorize DU to look at your bank account. So it's secure. It goes through, you authorize it to pull it, and it pulls 12 months, and it looks for a 12-month rental history. Well, I don't know about you, but a lot of the people that I have that have low or no credit scores, they don't often just write a check or send a Zelle every month for their rent. So we're not talking about a lot of people being eligible. And even of the ones that are eligible, if they're not sending that check out of a bank account that can be seen by DU for the last 12 months, it's not going to help. So it's good. There's nothing bad or wrong about Fannie and Freddie and FHFA and FHA and VA trying to find ways to be more inclusive, to get enough data to approve more borrowers. I just don't think this is going to make a huge difference in the grand scheme of things.
We are an inclusive society, Josh. Everyone should be included in everything and get a trophy. So tonight you get a trophy for clean shaven.
We try.
Being clean shaven. There's people in here asking why, Josh.
Try.
So Josh and I Josh is going to shave and I'm going to grow out a beard. So as long as Josh,
are you going to put a poll as to which way we should be? Should you be clean shaven and I should have a beard?
My wife's not going to like this. As long as you stay clean shaven, I'll continue to grow the beard.
Let's do it.
So,
and then when you shave it off, I'm going back hacksaw Jim Duggan. My wife won't let me actually grow the real beard, but when it comes, it's spectacular.
That touche. All right, so here we go. Let's go with this. Nathan has another question here, or a question this time versus a comment. Uh, how do you recommend vetting a realtor for purchasing a home? We are now looking for one in South OC. How do you recommend finding someone experienced as a negotiator and super knowledgeable? Good question. Uh, your best source of finding someone, quite frankly, is a referral. Just like anything, right? Finding a mortgage lender, finding a referral, finding a mechanic, dentist, whatever it is getting a referral from that person, someone that had a great experience, someone that can vet for them. That sort of thing. So that's where I'd start, is find somebody that recently purchased a home, friend, family member, that sort of thing, and see who they recommend. Have a conversation with that person. Check their reviews online. There's multiple sources now to check reviews. Some are a little bit more strict than others with regards to the reviews they can give and follow and all that good stuff. But check the sources. And then once you have somebody, maybe you ask to speak to, their last 5 people that they've done business with, sellers, buyers, whatever, and have a conversation with them. Get the name and number of those people and see what their experience was with that agent, and ask those questions. If you don't know of somebody, I mean, you're in Orange County, I can be a really good source for you. I do business in South OC all the time. Now, depending on how far south you are, I might not be the best fit for you. And I'll be completely honest, right? I don't go all the way down San Clemente, San Juan in a lot of ways, just because it's not my market. I wouldn't be the best fit. But if you're somewhere in the middle, Mission Viejo, Lake Forest, that far south, then I could be a really good resource for you. And if I'm not the right fit, I can put you in touch with somebody in that market, that sort of thing, right? Vetting them, asking the right questions, how many properties they've sold, how long they've been in the business, and talking to their past clients is probably the best way. Outside of that, it's tough. I wouldn't say that there's an absolute way it has to be done every time, but reviews are a really good source online. And don't just check the good ones, check them all, right? I mean, in some cases you won't find any bad ones. And I wouldn't say that that's a negative, right? I probably have 80 or so Google reviews online. That's just one source. And fortunately, there's none on there that are bad. And I don't just send that poll out to people that I've done. I send it out to everyone. And so that's the best way. Josh, any recommendations there?
Here's what I would say. I would put much more weight on a professional's recommendation of another professional than friend, family, coworker. Okay. And the reason why I say that, if you ask your coworker, hey, do you have a realtor for me in Laguna Hills? That's fancy. It's very fancy.
No, I'm looking for sponsors. I'm just throwing it out there, just making sure that they see it.
I just want you to know that if I were drinking a Bang Energy at 5:30 in the afternoon, I would be up at 5:30 in the morning, still bouncing off the walls.
I could sleep in 20 minutes now.
So now you stop interrupting me. I was saying something very insightful and important. What I was going to say is, if you ask your coworker for a referral for a realtor in Laguna Hills, they're going to tell you someone that they like. Mm-hmm. Hey, I worked with this person. They were great to work with. They were cool. They were nice. They don't necessarily know what they don't know. Now, if you ask a realtor, so again, Jeb, you don't want to go to San Clemente. It's too far. It's not your wheelhouse, but a handful of agents down there. Absolutely. And you know how they handle themselves, how they negotiate. So it's not to say you can't get a good recommendation or a good referral. It's a good start, and it's better than nothing. But in a perfect world, I would love to get a recommendation from a pro, from an escrow officer, from another realtor, from people that are working transactions with them. An escrow officer is likely to tell you, does this person manage their transaction? Is it likely to be smooth and easy throughout the process? A realtor is going to be able to tell you, hey, do they negotiate well? Do they defend and protect their clients on both sides of the transaction? So those are things that I would like to look at. And depending on how open to a little bit of conflict and uncomfortable conversations you are, ask them if they'll discount their commission, if they'll give you a refund. And you're gonna think that I'm saying, hey, if you can get someone to kick you back a couple $1,000s at closing, that's a good thing. And I'm gonna say, if you can win that negotiation with the realtor you're talking to, you probably don't want them representing you in negotiations on the other side, because they're going to be, if you look at, what do we talk about, Redfin, hey, they'll show you in the little listing, hey, we'll give you a $3,200 refund on this. A good realtor will save you $5, $10, $15, $25,000 in that transaction. Far more important than just negotiating well for you. And I say that, I have a transaction right now where both agents on each side are Redfin agents, and they're good and they're doing a nice job. I'm just saying, it's a way of finding out if that person, I mean, Jeb, if I asked you, hey, will you give me $5,000 back at closing? You're going to tell me no, and you're going to, in the way that you tell me no, you're going to demonstrate why I want you negotiating for me on
So
my
me
behalf.
hanging up on you is good demonstration.
You wouldn't do that.
I'm
You
kidding.
would never
I'm
hang up
kidding.
on
I
me.
wouldn't do that at all. No, I mean, yeah, no, it's a good point. Yeah, and having those conversations, but yeah, and along with what Josh said, talking to past clients is a good way too, just because you can get, sometimes you'll get it all right. I mean, they might have did a good job, but they'll have something, not to criticize, but a little bit more insightful to help guide you in your decision making.
And ask them specifics. What was awesome about working about? What would you change if you could? Did anything hairy come up where they had to negotiate with escrow or the seller or the selling agent? And just get some feedback. Try and get some specifics if you're talking to a friend or coworker about recommendations.
No, absolutely. We're going to move along here. We got Cindy Juggle Goddess. She is asking, how do I understand what property taxes will be on a single family home I want to buy in California? Are the values on the real estate websites accurate? So, Josh, you've pre-approved somebody to purchase a home, right? You need accurate taxes, a tax based on that to figure out if they actually approve or not. Where would you go to find that rate?
Well, here, I'll tell you what we do when someone's out writing offers, and I don't have to be dead on, but I want to get a reasonable number. What I'm primarily checking for is to make sure that the taxes aren't really high. That would affect our debt to income ratio. Doesn't matter why you're looking for it. If we just want to go quickly, I'm going to do a Google search. I'm going to pull up Redfin, and on Redfin, there says it shows you the price history and the tax history. If you look at the tax history, you can see what the home is currently assessed for and what the current tax bill is. Take the current tax bill, divide it by the current assessed value, and that will tell you the tax rate, and then multiply it by what you're likely to offer for. Now, when it comes down to when you send over a contract, when you say, hey, Joe Smith has an offer, I'm sending you the contract that's accepted, we're going to go into the title records, and we have a tool that will spit us out exactly what the taxes are. But Redfin does a good job of keeping accurate numbers there. Their tech is really good.
And you can also do, I mean, like depending on where you're located, like for example, here in Orange County, the tax records are public, as Josh mentioned, right? So you can type in Orange County tax assessor. Yeah, Jesus. You can access the county tax records, and you can type in a property address, and it'll pull up the current tax bill, and it'll show you the tax rate on there. It'll show you what the basic tax rate is. It'll show you with any bonds, any potential Melrose, anything that's added onto that to give you an effective tax rate. And then you, again, multiply that times the purchase price, divide it by 12, and that'll give you the monthly. All right. So let's move along here. RT says, please comment on the Bellevue, Kirkland, Washington area. Pre-approved for 1.8, looking for a deal. Strong financials and a great job. Thanks in advance. So I know that neither of us know that area well enough, but Josh has more knowledge of it than I do, considering his wife is from upwards of that. Well, not that area, but somewhere in that ballpark.
Yeah, Bellevue's about 45 minutes. She's from Olympia.
There you go.
Bellevue's
so any insight
on
on Washington at the moment?
Well, Artie's saying he's looking for a deal. Don't look in Bellevue if you're looking for a deal. It's sort of the Orange County of Washington. It's a higher end area, a lot of high paying jobs. Artie, as you can see, a pre-approved for 1.8 million. Artie's doing fairly well to qualify for that home. So it's a strong market. Washington has been a really strong market. We talk about, all real estate is local, but when you look for the last 3, 4, 5 months, when the month over month figures come out and you say, what are the hottest markets? Phoenix and the Seattle area have been two of the hottest. So don't know that you're going to be super successful in terms of looking for a deal, but it's a highly desirable market. It does well, when markets are up or down. Just find a home that you love, make the best deal you can, and stay there for 5 to 7 years.
Awesome. I just read a comment. Somebody said I look like Triple H.
I
need longer hair and a longer beard for that. And more muscles.
I don't want to know what Triple H looks like, and I'm disappointed that D is a WWE viewer.
You don't know what Triple H looks like?
Mm-mm.
Then how did you know he was a WWE viewer? See, bro, WWE. You just throw your car. You lied. You know who he is.
Here's what I'll tell you what he looks like. He's a good-looking guy with a lot of muscles and long hair. So I'm not sure. I'm not seeing the comparison.
The resemblance? Yeah, me either. All right. Let's see here.
Hey, we had one here, and I don't know that I have a super insightful answer, but I did want to cover it. Flash of Light says, if the rate and the APR are the same, that means no closing costs. So let's kind of talk about what's the difference between your interest rate and your APR. A lot of times we send out numbers and we tell people, and it actually shows the APR on there, but there was well, what's my APR? Well, what's my APR? And my question to that is always, okay, well, tell me what the APR is, and then I'm going to tell you what your APR is on this loan. So Flash of Light has pointed out correctly that APR takes into account that for the most part, you're going to pay closing costs for any loan. So certain closing costs, but not all of them, are considered prepaid finance charges. So in a super simple example, if you were getting a $300,000 loan and the interest rate is 3% and you have no closing costs, no prepaid finance charges, your APR is 3%. If you had a lot of APR affecting prepaid finance charges, you could be looking at an APR of 3.4 or 3.5%. So for the most part, you want your APR to be as close to the note rate as possible, but it's a synthetic number that's made up by the government for comparing options between different lenders. So we've talked about this on the show before, and I'll say it again. The most important thing you can do is ignore APR, get a loan estimate, and on a purchase, you're looking in box A. In box A, those are all the things that the lender controls. Escrow, title, recording, all those other things are going to be selected for you throughout the transaction and will not vary from lender to lender. But box A, you want to know what's the note rate, what are your box A charges? And the reason why I say that's on a purchase, on a refinance, we, as the lender, generally select escrow and title, so we have a little bit of control over those items. But from a reputable lender, they've probably negotiated those down to a fairly low level within $100 or so of one another. So yes, in this situation, if the rate and the APR are the same, there should be no closing costs for you there. That's almost impossible to do in the real world in the way it's disclosed. So I'm concerned that you might be seeing a mailer from someone, or someone sent over a number and is telling you that the rate and the APR are the same, because most likely when you see your loan estimate, there is going to be a slight difference between the rate and the APR.
No, good information. I mean, that's a question a lot of people have, and it's good to break it down. Here's something that I see a lot of people talking about, and quite frankly, I don't really think it matters to anything. Lumber. So lumber is now at pre-pandemic levels, Josh. It's back below. So do you think the cost of an existing home is going to drop because lumber's gone down? I'm asking.
No,
right? How was it ever a factor to start with? It was never a factor. It was an easy media frenzy to target that lumber's going through the roof. What it impacts is it affects the cost of a remodel. It affects the cost of people flipping homes. It affects the cost of people building homes, right? Guess what? Even though those lumber prices have gone down, do you think builders are now going to drop the margins on their properties to match those inventory levels? I mean, those lumber prices? No, they're not. As long as demand stays high, which it has, or supply stays low, rather, demand stays high, the price of lumber isn't going to affect anything. In fact, it was never a factor in the reason that home prices went where they did. And so the fact that they pulled back, everybody wants to use this as lumber's crashing. Who cares? Great, go out and buy some if you want. I mean, what do you want to do with that? Josh, you should go buy lumber futures. Tell me how this matters at all. I see a headline everywhere, and it absolutely has no bearing on existing construction in the housing market.
No, and it still hasn't changed because most, as the prices were spiking and all of the builders got spooked, they were buying in the futures market. So it's going to take a while for it to shake out for them to get to benefit from the lower lumber prices because they had already bought and hedged in the futures market.
No, agreed. But anyway, I saw that. I wanted to click on it. Rishi has a question here. She says she used a Redfin realtor to put an offer on a house, wants to use another realtor now. Can you do that? So assuming you haven't signed a buyer broker agreement with that real estate agent, you can use whoever you want. Now, in the case that you've signed a buyer broker agreement with that agent, then in theory, based on whatever the term of that agreement was, that is the agent that you're supposed to use when writing an offer. And if you don't use that agent and write it with someone else, then essentially that agent is still entitled their commission for you purchasing whatever property it is. Now, here's the deal. I've been in the business almost 20 years. I've never had a buyer sign a buyer broker agreement. Now I'll have agents tell me, dude, you're crazy. Like, why would you do business and not have that sign? Well, I mean, have I gotten burned before? Sure, I have. Absolutely. So let's just start with that. But at the end of the day, I want to work with people who want to work with me. So if you find out we're not a good fit through the process and you want to move on and go forward with someone else, so be it. I mean, I don't want to hold you in a transaction that you don't want to be a part of, right? Just like if I'm listing your house, even though we have an agreement and you decide you don't want to work with me, I'm not going to make you work with me. That it seems crazy. No agreement should bind somebody in that way. But unfortunately, those agreements that's what they mean. But what I would tell you is that most of the time, if you have a conversation with that agent, if you have one of those or the broker of that company, then, the broker will often either let you out or maybe connect you with another agent at that company. And maybe that would be a better fit. But in the case that you haven't signed one of those, then you can use whoever you want to make an offer. So just know that moving forward. And on the mortgage side, there's nothing like that, right? I mean, fortunately or unfortunately, however you want to look at it, when you move forward with a lender, you're not necessarily entitled or have to move forward with that lender at any point in the process. Now, it could backfire on you depending on where you are in that process, but there's nothing that binds you to a certain lender.
And that's a big one that we always get, Jeb. When the disclosures go out, people freak out. Oh, I don't want to sign this, or this is $5 off. You're not agreeing to anything with those disclosures. So let's say that you got a property under contract, you had talked to an initial lender and they send out disclosures. Even if you sign those disclosures, we don't have anything binding you to the transaction. Now, if we order an appraisal and it's on your credit card, you have the cost there, and people will try and do that to get you to charge an appraisal on your credit card to tie you into the transaction. But for the most part, as long as you have time to find another lender and get your transaction closed in time, there's nothing that we have in the file that binds you to us other than our goodwill and good faith effort to get you exactly what we talked about. So if you feel like someone is changing things on you, lying to you, not giving you the facts, as long as you have time to find another lender and get closed in time, you can do that. And hopefully the person you start with the process with makes you happy and you don't feel the need to do that. So Jeb, I've got a couple of good ones over here. They're not actually questions, but we so Rishi simply is also looking in the same area there of the Bellevue area, but then Artie followed up and said, thanks for the good advice. Artie is a she. So foolishly,
did I say he? I probably said he.
I think we both did. I think we both called Artie a he. So we stand corrected on those notes. And then probably the most important note here that I wanted to make sure we're all aware of, he don't have long hair anymore. That's referring to Triple H. That's why you look like Triple H, because he shaved up his hair trying to look like Jeb Smith.
Dude, I mean, it happens, bro. It happens. Can't fault the guy for that. Let's see here. I'm going to follow up to Nathan here, basically saying that he's met with a few folks who were referred by friends, had a bad experience. So I'm asking for you. Here's the deal, Nathan, call me. Let's have a conversation. And if I'm not a good fit for you in this market, I'll refer you to somebody that I feel like is. How's that? Obviously I'm biased towards my own business, but I'm happy to put you in touch with somebody if that's what you're looking for. Let's see here. Yeah. And he goes on to say that he referred to a big agent who connected him with the junior agent, that's only been selling since November. Again, in this market, there's a lot of team environments out there, a lot of people running teams, and a lot of times you're not getting who you actually hired in those cases. So that's a question to ask up front. That when you're talking to these people, am I getting you or am I getting someone else during that process? So just keep that in mind, and again, reach out and we'll have a conversation. Michael's saying the Bang energy drink flavor that's the best is Sour Head. Can't do sour, man. Can't do sour. Just leaves a bad taste in my mouth.
Do you like sour beer?
I don't like sours
like sour
either.
Beer?
No, not a sours guy.
Our friends over at Four Sons have Sour K, which is
maybe they'll sponsor us. Hey, we're looking for sponsors here on the show. You just
said you don't like their sour beer. Why would they want to sponsor
other beers? I don't need the sour.
That's true.
I'll get the Dirty Heads.
The Dirty Heads is some really good beer. I don't know. I'm not a huge Dirty Heads fan, but I'm a fan of their beer.
There you go. All right. So I saw another question here and I was about to click on it and then somehow I moved my cursor and I lost it. But all right, here you go. Roy Cho does FHA have a maximum purchase price? Josh, so there are certain restrictions on conventional loans and FHA loans now. So why don't you answer that question and help Roy find out how he knows that price?
So there's a maximum loan amount, but there's not a maximum purchase price. So in theory, if you wanted to go buy a $10 million house, you could get an FHA loan on it up to the maximum FHA loan amount. So for example, here in Orange County, $822,375. So if you want to go up into Newport Coast and buy a $10 million home with an $822,375 FHA mortgage, you are able to do that. So no maximum purchase price to worry about there.
But let's ask the other question. What are the maximum loan amounts then? So if I am looking to get an FHA loan, is there a max loan amount and how do I determine that?
So the max is the high balance limit. So right. Orange and LA County, you can go up to $822,375. Now, when you go outside of areas that have the high balance loans, it's set on a county basis. So you almost have to look it up because it will vary county by county, and it does not match necessarily the conforming loan limit. So right now your Fannie Freddie max loan amount is $548,250. They don't necessarily match that. So for example, for us in Riverside County, we have a lot of clients that get priced out of Orange and LA County. They go out to Riverside, San Bernardino County, and it figures in the high fours now. I don't have it off the top of my head, but they vary all over the place, and huge variances. They can be way less than $548,250. They can go as high as $822,375. Yeah,
I think the low's in the threes somewhere, depending on what part of the country you're in. I think you can be in the threes for the maximum loan amount. But yeah, and typically, Josh has mentioned this before, but they're going to announce any revision to those numbers probably here in the next 2 months or so, which is probably going to increase those numbers moving forward. So, and give people more of an opportunity to use them at higher amounts. What are you laughing at here?
I don't know what I ever did to Michael. He's just always trying to mess with me, saying that I'm going to be the retired guy drinking at 8 a.m., screaming at young kids to stay off his lawn.
He already is. That is him. You nailed him. Is Michael your neighbor?
I'm gonna stop showing up. If you guys are gonna be abusive towards me, or I'm gonna block Michael Dury, that might be it. Yeah, and Jennifer points out rightfully so. Nope, that's Jeb.
Dude, I'm yelling at my own kids. I'm not drinking that early, typically.
I'm not a morning drinker. I will not drink until afternoon.
Yeah, I'm. The mimosas, I could do that.
No,
but anyway. All right. Let's see here. Ricardo's got a question asking, Jesus, this D guy, dude, is he just lit up the chat or she? Like, holy cow, like every comment. I'm assuming that's who
Who thinks you
Jennifer
look like Triple H?
blocked. Yeah, she put him in timeout, or her, or yeah, whatever. Anyway, what required documentation is required to refinance, Josh? And maybe you can talk about just conventional, and you can also talk about maybe if you're on the FHA side or VA side doing one of those loans as well.
The documentation is really not going to vary for any of your standard loan programs: Fannie, Freddie, FHA, VA, USDA. So
For
let's
refinance.
talk about for a refinance. So let's talk about the simplest situation. Someone who works for someone else, is not self-employed. So we're going to need 1 month of pay stubs, and we're going to need at least 1 year of W-2s. Now, conventional 1 year is enough. FHA and VA will generally require 2 years on that. So what do we need in addition to that? We need a mortgage statement, because we're going to have to order your payoff demand. We have to know how much you owe. We're going to need your homeowner's insurance, and we're going to need government-issued photo ID. So in the simplest transaction, that's all we're going to need: pay stub, W-2, mortgage statement, homeowner's insurance, photo ID. And you may be saying, well, you said FHA and VA. FHA and VA have streamlined refinance programs where we don't need the income documentation. If you do not need to bring in any money at closing, then we don't need bank statements. So if you're getting cash back, or if it's just set up where you're not going to bring in any money, we don't need bank statements most of the time. Sometimes you will need reserves, and in that instance, we would need to get a couple months of bank statements. Now, if you own rental properties and or you are self-employed, we may have to collect tax returns as well.
No, sorry. You were talking, I was reading a comment, and I actually pictured what Rishi said in my head, asking me if I could spit bang like Triple H does. And I actually pictured myself just doing it and just blowing it everywhere. And it made me laugh. Although I wouldn't do it here just because I'd have to clean it up. But, maybe one day I'll just do it. Like, what the hell? And we'll just go for it. Anyway. All right. Let's see here. I saw a question earlier I wanted to address. It was about renting a home out. So Ted asked, I am trying to rent out my current house and buy a second home. Should I wait for moratorium to end prior to renting my current place out? So my first question for you, Ted, would be why? Why do you think waiting for a moratorium to end is a better opportunity for to rent your home, right? I think right now, more than anything else, you have a suppressed, if that's the right word, number of rentals, right? There's not a lot of inventory out there in the rental market, at least here in Southern California. Rentals are in very much demand. And part of that could be because of the moratorium, right? Some of the properties that would be potentially coming on the market are not, because there's renters staying in them. So I think if you were to rent it out sooner rather than later, it means less competition potentially. But also, regardless of when you decide to rent it out, whether it's before the moratorium or after the moratorium, what I recommend is that you find somebody that has good credit, has a good job history, and somebody that has some reserves in their bank account, and that potentially, the biggest drivers, and maybe a good rental history. If you can get that information and obtain it and have proof of it and all that good stuff. But more importantly, somebody that usually has good credit, especially through what we've just been through over the last year and a half, you'll see people being able to pay their bills on time and what have you, right? This is probably the biggest financial issue as that we've seen since the last crisis, if you will. So if they were able to make it through, then chances are they're going to be okay moving forward. And while you can't predict the future, all you can do is look at past history of how they've paid, bills and that sort of thing. And credit is a good factor to look at when doing that. So, stable job, good credit, money in the bank. And I think if you do those three things, regardless of when you decide, you're probably doing all you can to make sure you got the best candidate possible. Josh, is somebody that owns rental property. Thoughts? Anything you would add to that?
I don't think you have anything to worry about in terms of the moratorium, because you're going to be seeing these people's history, and you're going to be able to ask them on the loan application, what was your work history? You can ask them, well, did you have any downturn in income during the COVID crisis? So you just want to ask them and be super straight with them. It's honestly, it's not all that hard to see who you're dealing with when if you're vetting them and getting the applications yourself. And Jeb, you do this for clients all the time. It's not hard when you see
No.
how they complete the application, when you see what the credit looks like, when you see what the employment history looks like, their work history or their residence history. Like, I don't want someone that's been in 5 different apartments the last 5 years. Like, we want someone who shows stability in employment, in their residence, that their credit. So, everyone loves to complain about how hard it is to get a rental property. And I can tell you, every time I put a property up for rent, I am stunned at how few people would I be happy to rent the home to.
No,
Just be
absolutely.
someone that meets that criteria. Be someone that you would be happy to count on to make a rent payment every month.
And you make a good point there, Josh. So if you're a real estate agent and or someone leasing your property out yourself, if you've got somebody that's super needy on the other side of that transaction, and or they're making it difficult, or the communication's not good initially, that's what you're going to have as a tenant. So, not only do you want somebody that has good credit, will pay you also want somebody that isn't going to call you for every single thing that they find wrong with the property. Not to say that the property shouldn't be, what you advertise it is, but at the same time, if the toilet breaks, or it starts to leak in the back, or whatever, however you want to, the piece in the back. I don't even know what the hell that's called. Not the flange, the thing in the back. Anyway, that you just go out and fix it. It's like a $15 part. Like, and if you don't know how to do it, your boyfriend, your husband, your wife, whatever, like that sort of thing. It's like, you don't need to call somebody for every single thing. And what I found is that people that are super needy through the process are not good tenants. So just keep that in mind. When you're going through the applications and you're having those conversations up front, it could save you some headache in the end of the day. All right, let's move on. Jennifer is just killing it tonight. I love it. She's just throwing people under the bus and dragging them. Not just throwing them under the bus. She's dragging them, Josh. Good for you. All right, Nicole, can you avoid PMI with a 10% down payment, Josh? And is your interest rate higher if you're able to do that?
So with only 10% down, that loan is getting insured one way or the other. Unless you went to a private bank that says, hey, we're cool with 10% down with no mortgage insurance. And even at that, they're likely to charge a higher rate of interest to cover their additional risk. So you can pay monthly mortgage insurance. You can pay it up front in terms of a one-time lump sum payment. You can pay it in terms of a higher interest rate where the lender just covers it as lender paid mortgage insurance. So it is always going to be there. There are multiple ways to avoid it showing as to avoid it showing as a line item on your monthly payment. But the best thing you can do is, if you're interested in alternatives, ask your lender to line them up for you and show you a side-by-side comparison of what is going to have the lowest monthly payment. With 10% down, for the most part, I'm going to recommend you just bite the bullet and pay the monthly mortgage insurance, because at the rate this market is going up, in a year or two, you're going to be able to get rid of it. If you roll it into your loan amount or pay an upfront lump sum premium, it's money gone. You're never getting it back if the market changes, you sell the home, market goes up, any of that fun stuff.
No, absolutely. We got a couple good questions here as well. Richard's got a question about, would I need to pay for an appraisal with every offer I make? Josh?
No, sir.
Right. Okay. So not with an offer you make, but let's say you go under contract, and that your first property, you put in an offer, it gets accepted, you get an appraisal. Appraisal doesn't come in at value, or the deal falls apart for whatever reason, and now I decide to back out and I go buy another property. Do I have to get an appraisal on the next property too?
Absolutely.
All right. Yeah.
You're always going to need an appraisal. And just to follow up in terms of timing and everything, the thing that is taking the longest in every transaction right now is the appraisal. We don't have enough appraisers. We don't want to go into why we don't have enough appraisers, but a lot of demand for appraisers to go out and appraise properties, a small supply of appraisers. So we are ordering it immediately as soon as we have a contract. So if something happens and that deal falls apart, you have an inspection 3 days later. If they've already gone out and done the appraisal, we can cancel it, but we're going to pay at least a portion of it if the report hasn't come in. But it's something, just in terms of the timing of your standard 30-day escrow, we need to order it straight away. Does it happen very often that something falls apart and we end up going into another property? Not very often, and we'll work with the client. I don't want you to have to pay for 2 appraisals. We had one earlier this year, and we ate the first one and just didn't collect it. We still made the money on the second deal and didn't want them to feel like they were in a bad spot and having to pay for 2 appraisals.
Okay, now I have a follow-up question to that. Second, what if I get an appraisal on a property? You're my lender. Well, no, let's say I'm the lender, and they decide to can me and go with you. Can they transfer that appraisal to the new lender once it's been completed?
Definitely, maybe. It's not always, and it can be, especially in a purchase transaction. We do it more commonly on a refinance. Someone gets into a refinance for whatever reason, it falls apart with Jeb's mortgage company, and they want to come to Josh's mortgage company. We've got time to work through that, and so that happens fairly often. On a purchase, it doesn't happen super often that it gets transferred, but it can. Where it generally can't is a jumbo loan, FHA. And VA, the appraisal actually runs with the property, so we have to use that appraisal, and we'll go through FHA and VA to get that. On a conventional loan, most lenders will allow a transferred appraisal, and there's a process for doing that.
All right, and then the last part of this question is, I get multiple appraisals, right? The first deal falls apart. As we mentioned earlier, I decide to purchase another home, get another appraisal. Am I paying the appraisal fee out of my pocket up front, or am I able to finance that cost through the loan?
So it can be collected at closing. You can't finance any closing costs into your loan because that would impact your contribution of your down payment. Let's say you're putting 5% down and a $300,000 purchase, $1,000. If you try to finance your appraisal of $500, you're now putting $14,500 down. It impacts your down. So you can't finance it. What I can say is what we do. The government wisely, when they changed sort of the process for ordering appraisals and also disclosures, we cannot charge you for anything in the transaction until you have your disclosures, which can take a day or two. So we don't want to lose a day or two in a purchase transaction. We're going to order the appraisal. We're going to order it on our credit card, and it's going to be collected through closing on a purchase transaction.
No, good stuff. Good solid answers to that. Like I set you up, bro. I'm a good hype man. I'd be a good wingman.
You'll be
setting
like
you up for solid answers.
You'll be like Diddy in the Biggie video. I'll have the red and black lumberjack, but you'll be over there hyping everything up.
Exactly. That's perfect.
Cool.
Oh, too good. If I sold my house, this is coming from Roy, would my credit score go down? Josh, if you're selling your house, how does it affect your credit?
The interesting part is he has a fair credit score. Ignore the Wolverine over my shoulder. That's just my dog. If you have a fair credit score, so what is fair? It's interesting. Credit scores, the distribution is actually much higher than most people think. I believe the median credit score in the U.S. is somewhere in like the 730, 740 range. So if you're above 700, paying off a mortgage, refinancing a mortgage, it will have a small negative impact on your credit score, but not significant. So if you're on one of those thresholds where you're just over 700, it could knock you down a little bit and put you into the 690 range. So there's one of the things we get people all the time, they don't want their credit pulled. Well, I want to see what you can do, but I don't want to pull credit, especially if they have fair credit and not excellent credit. If you have an 800 credit score, us pulling your mortgage or pulling your credit report or you paying off a mortgage, you're going to have a very minimal impact on that. But if you're in a position where it could change things, just a long way of saying, it's really hard for us to give you any definitive answers without a credit report. And once we see the credit report, we can generally tell you how big of an impact these things are going to have moving forward. And a lot of times, I just went through with a client this morning. We're trying to get up over a 720. We went through. He's got about 20 grand, and if he pays off $20,000 of debts, we can get him to a 720. But the only way we can give you that insight and that information is by pulling the credit report. So I always tell people, I don't want to pull your credit. It costs me 25 bucks every time I pull someone's credit. I don't generally like burning $25. So there's a reason why we want to do it. There's a value in it, both for you and for us, is why we want to pull the credit. It's not just trying to get your credit pulled.
No, good stuff. I saw a question earlier that I've been trying to find here while you've been talking, asking about your thought on non-QM loans. I can't find it now. If you want to just address it, you can. Otherwise, I'll find the question here in a minute and try to put it up there. But
yeah,
it was basically that.
Let's talk about what a non-QM loan is. It's a loan that does not meet the qualified mortgage guidelines. It's the definitions that the government had set up to give lenders protection against lawsuits. So basically, you're saying that you've gone through, you've shown ability to repay, you've met the government's requirements for debt to income ratio and all of those things. So the most common types of non-QM loans are a bank statement loan, where instead of using tax returns or pay stubs and W-2s, we're using bank statements, either 12 or 24 months, to calculate your income. There's also loans where we use the rents. So your mortgage is going to be $3,000, the property rents for $3,500. They show that as ability to repay. So we had a question last week. The gentleman actually followed up after the show and said, hey, do you feel like these bank statement or business purpose stated income loans are the new return of subprime, and is that going to be a problem? I told him, I do not believe it's in any way a problem, because they require bigger down payments. You're paying a premium interest rate. So anyone that's willing to take that loan is unlikely to be doing it to circumvent the ability to repay guidelines. And the biggest thing is, if you're looking at the non-QM loans that are limited only to non-owner occupied homes, the lender is going to verify that you have a place that you live, that you either own your home. They're not going to allow you to use rents to qualify on a home that you intend to own or occupy. So Howard, if your question here is your opinion of non-QM in terms of you using it to qualify, no problem whatsoever. The terms are getting more competitive. If you put 10% down on a $500,000 purchase and you qualify with a full doc loan, you're just under 3% right now. You're probably looking on a non-QM loan in the high 3% range. So you're still paying about 1% premium in interest rate for a non-QM loan versus your standard full doc Fannie, Freddie, FHA, VA loan. But if it's the only way to get into a property, we've talked about this a million times here on the show. Definitely get into a home with whatever it takes for that to happen. Because the non-QM loans are still attractive loans, just not quite as attractive as the full qualifying full doc loans.
No, good response there. And I know some of you are reposting your question because we haven't answered it. Understand, we'll try to get to them, right? You don't need to repost. There's a lot of good questions tonight, some that we haven't answered before, so we're trying to get to those. So just hang tight. And some of the questions are the same, so we're trying to, get those done as well. We're 204 people in, just over an hour. If you haven't done so already, hit the like button. Josh has COVID. I mean, the guy's here. He's giving answers. Give him a like to show that, you like him being alive.
I would say that the Delta COVID does appear to be like COVID light. The real people, the tough people, are the ones that had it last year when it was new and aggressive. It's kind of toned down.
Oh, there you go. All right. So Rose has a question here. Rose says, should I go all in on the first offer or save some for the counter? Thanks. That's a good question. And I think it's going to depend on your market, right? All real estate's local. What I can tell you here in Southern California, from what I've seen, and now maybe not so much in the last week or 2 weeks, but a lot of offers that we put in with clients, we didn't even get a counter offer. Just because there were a lot of offers going well above the asking price in many cases. So we didn't even get a counter offer. And so what I was advising clients to do is, hey, listen, Here's the deal: submit your best offer up front. And at least maybe we can get a counter offer. Maybe we're accepted, but at least we're in the game. Because if you're holding back with the idea that you're going to negotiate, that you've got more to offer, you might not even get to bat. And so I think in this environment, even though things have slowed a little bit, I think you still need to go in with your best offer. And maybe that continues to be your best offer. Maybe you get countered back and you counter the same thing. You don't, just because you get a counter offer doesn't mean you have to counter higher when you respond. If you wanted to counter lower, you could. I mean, so just get yourself in the game if it's important to you by submitting a strong offer up front. And maybe it is your best offer. Maybe you save a little bit, but nevertheless, I wouldn't go much off that, because otherwise you might not even get a response. And I've seen a lot of that in this market. In fact, I'm writing offers for a buyer at the moment in North Long Beach area, and it's a competitive market. I mean, properties in that market sell anywhere between like 550 and really 650, 700 now, and we put in a handful of offers, and I would say half of these we've zero response on them. Just because the number of people submitting and somewhere where the prices are going. And we might not have even been a player had we submitted our best offer in those cases. But there was still a little bit left in the tank, and we didn't get a response. So hopefully that's helpful for you. We did have a super chat coming in from Miss Shelton 226. Love the Biggie Puffy reference. So if I bought my,
she thinks she sees the similarity between the two of us and Big and Puff.
Oh, absolutely. That's exactly what it is. I'm sure of it. So if I bought my house at 3% in November, do you recommend trying to refinance if my credit score is higher now? I'm conventional. What bank should I try? So Josh, I've talked about this on video. There's a couple of times when you should actually consider refinancing. And one of those 4 times that comes to mind is if you got your loan and your credit score has actually improved since then. And in this case, it's been 9-10 months ago. Might be an opportunity to take advantage of lower rates. But what are your thoughts on that?
So rates aren't all that much better than last November, probably pretty similar, but with 3% down, that's essentially minimum down, and that home has gone up
at 3%. She got a 3. I'm assuming 3% interest rate.
We don't know. Miss Shelton, you need to follow up and give us some more insight.
Yeah, I'm assuming 3% rate is what she has, maybe, and then she's considering trying to go lower. So I don't know. We'll find out. And answer the rest of that, and we'll get on that question for you.
Exactly. So in terms of trying to determine when it makes sense, we've talked about this before. The simple and easy rule of thumb is take $125,000, divide it by your loan amount, and that will tell you how much you need to save. So if you have a $125,000 loan, $125,000 divided by $125,000. How about, since she's still here and helpful for us,
what's your loan amount?
What was the loan amount, and how much did you put down percentage-wise?
Yeah, there you go. And we'll answer that. And so, yeah, go ahead.
So yeah, we'll actually tie it back to your exact example here. But 125,000, if you owe 125,000, we need to save like a full % to make it make sense to refinance. If you owe $500,000, we only need to save 1/4% to make it make sense to refinance. So if that's the case, you owe $500,000, we can probably get you 1/4 lower right now, maybe even a little bit more than that. If you also have mortgage insurance, that could be another factor that comes into play there. As your credit score goes up and the loan to value goes down, mortgage insurance is going to be cheaper, so we can save on the interest rate and then also on the mortgage insurance. So those would be the big things that we're looking at. And then the last piece you said is, hey, who can I talk to, or who would you recommend talking to in terms of refinancing? Jeb and I have a big network of lenders throughout the country, so let us know where you're at. Reach out to us by email, and we'll get you connected directly with someone that can.
And there's also a link in the description. If you click on that, get you connected as well. But she owes 213. She put 30,000 down. So 213, divide that by 125, a little more than 0.5%, right?
Yeah. So you need to save a good chunk, but with 30,000 down on that 213, it was a little less.
It was 247 with 30,000 down.
So, but 30 on the 247, it's less than 20% down.
Oh,
So
got
there's
you.
some
Right, right,
mortgage
right, right.
insurance there. So with the values likely having gone up, you may be able to get rid of the mortgage insurance. So slightly complicated and a little bit difficult to answer in this format, but definitely let us know where you're at. We'll get you connected with someone that can get you the right answer.
No, and thanks for the super chat as well. Much appreciated on that side of things. So Maria asked a question earlier. She asked it a couple times here, but I want to answer it for her. Can I move a loan that I already have to keep the same APR interest to a different home property if I sell my current home and buy a new home, same sales price? So if I have a loan right now, Josh, on a house, and I sell that house, can I keep my same exact loan on a new one?
The loans all have a due on sale clause. So as soon as you sell the home, you're going to have to pay it off. Some loans are assumable where the next buyer could assume that loan and keep it to acquire your property, but you will not be able to take the loan to a new property because of that due on sale clause.
All right, good stuff. Another question that we haven't really seen before: will an SBA loan affect my chances to get a mortgage? Self-employed, and that loan is not on my personal credit. It's in a business name.
So it won't impact you in terms of they're not going to look at it and count it against your debt to income ratio, but the repayment of that loan is going to be counted against the cash flow for your business when we're determining what your qualifying income is. So not in a direct way, but it would in an indirect way as it impacts your qualifying income.
All right, that's good. That's good stuff. This is a variation of a question I saw earlier, and I don't know if it's the same one or not, but I'm going to click on it here and we can address it. Guakel. Jeb and Josh, could both of you please talk about co-borrowing on a refinance and the tax implications of adding the co-borrower to the title? The co-borrower is my nephew, and he would move in. And earlier we had a conversation or a question too, Josh, that you can also address about potentially refinancing, removing one borrower and adding another to that. So let's address this question first, and then I'll try to find the question on that one that I read earlier.
So there's no tax implications in terms of anyone having to pay any form of taxes. The only tax implication you need to think in terms of is moving forward, who is going to take the interest deduction for your income taxes. So co-borrower, we add your nephew moves in, you both live there, you both get shelter, you both pay a portion of it. How are we going to allocate the deduction is really the only question that you have there from a tax standpoint. In this situation, I like this more than a lot of co-borrowing situations. The one that a non-occupying co-borrower, or oftentimes someone will co-borrow and say, hey, well, I'm going to take myself off a title. I don't want to have an ownership interest. It's their property. There can be downsides to it. I mean, you're counting on that person making the mortgage payment and making it on time and protecting your credit going forward. And unfortunately, Jeb and I see a lot of files, a lot of situations, and I see handfuls of them every year, 2, 3, 4 of them, where a situation that started out good and everyone was on good terms and doing well and decided to borrow together, and things go sideways and people end up in a bad spot. We talked about the home that I own in Orange now. That was a son and daughter-in-law co-borrowed to help the father refinance. And at the end of the day, everyone's credit got destroyed and everyone had to sell the property. So that's sort of your worst case scenario. But you always want to be aware of what the potential worst case scenario is.
Absolutely. And here's the other question that I saw earlier. It was a little bit different than I had originally read or what I thought I read, but spouse and her family bought a house under the brother and sister's name. Is there a way to refinance and replace one of the siblings with herself? And then also just ask the question of replacing somebody that's on a mortgage. So let's address this first here. So can you refinance, pull somebody off and add somebody else?
Absolutely. So as part of that refinance, we're going to do a deed from the current vested owners to the new vested owners. In certain situations, you may need to record the deed prior to getting our preliminary title report, but most of the time we're able to do it through the transaction. And basically it's a deed from the brother and sister that are on title right now, removing one of those and adding your wife into that transaction. And your lender and their escrow officer should be able to help you with preparing and recording that deed through the process.
Also, let's go a little bit further on this question because I think some people can get some good information out of this. So, say I'm going through a divorce. Husband and wife are on title. They decide that they're no longer going to be together. The wife's going to keep the property. The husband says, "You know what? I want myself removed from the mortgage. Can he just remove himself from the mortgage? How does that work?"
You cannot be removed or released from obligation on the mortgage without doing a new loan. So you can get off title, you can relinquish your ownership interest, but then we get back to that last situation that we were just talking about where you have no rights in the property. You can't even, you have no rights. You can't compel anything in that situation, but you're depending on someone else to make the payments on a loan that you're obligated on and will be reported on your credit report. So the best case scenario, thankfully we're in a really low interest rate environment. If the spouse that wants to keep the home is able to qualify on their own, then by all means, we can do that loan, take the departing spouse off of title and off of the loan.
All right. Hennessy has a question here asking, if you get a pre-approval, but your credit score increases, will the new score be factored in prior to closing?
Yes, 100%. And this happens. The only restriction that I'm really aware of, and it's not all of our lenders, but one of our lenders looks at it this way. They sort of lock in the credit score that we're using at the time your closing disclosure goes out. So if we're working on your credit and doing a rapid rescore and trying to get your scores higher, with them, we want to make sure we don't order your closing disclosure until that's done. With most of our lenders, it's simply a change of circumstance. We pull the new credit report, we have the new higher scores, we provide it to the lender, and they update the lock to reflect the new credit score.
All right. I'm just going to keep drilling you with questions here because this is easy. I don't have to do anything. What determines my loan amount, my income or my credit, Josh?
Short answer is both. Let's give you the accurate answer. Income has the greatest impact because obviously we're looking at your debt to income ratio. The more income you make, the higher we can go on your loan amount while still maintaining by staying within the limits of the loan program's guidelines. So where does credit come into play on that? Most loans use an automated underwriting system. The automated underwriting system is a pure black box. I can't tell you what the maximum debt to income ratio is for you. I can tell you in general. So on a conventional loan, we can most times go to 50%. Sometimes it's only 40%. Sometimes it's even lower than that. And when is it lower? It's for people with lower credit scores. Lower credit scores, higher, the lower your credit score is, the less likely it is going to allow you to push that debt to income ratio. So if we're trying to qualify you for the maximum amount, we obviously want as high of income as possible and as high of a credit score. But for the most part, the income is going to be the primary determining factor of your maximum loan amount.
All right. Good stuff. Just reading here.
Well, here we got another one. You don't want to talk. You just want to throw questions at me. So read that one.
Go, yes, sir. Josh, as a lender, would you suggest dropping 20% down payment to cut PMI and lower payment, or should I put 10% down, take on PMI for a few years, and increase deposit to make offer look more attractive? So Josh is going to say,
numbers never lie.
There you go. So what does that mean, Josh?
Run the numbers. You're going to look at them side by side. For most people with high credit scores, they're kind of surprised at 10%, 15% down, how little the mortgage insurance adds to the loan amount. And then also, let's say this is easy math for me. My brain's not working great today, so we keep using the $500,000 example. 10% is $50,000. People go, oh, geez, I put $50,000 less down. Isn't that going to shoot my payment to the moon? With current interest rates, it's about $5 per thousand. So the additional $50,000 of loan would cost you about $250 a month. The mortgage insurance is going to add a little bit more to that. For me, I prefer being liquid at the current really low interest rates. So I would probably lean more towards the 10% down, but there's not a right answer. My answer is not the right answer. Your answer is the right answer. So we want to do a side-by-side comparison. In this situation, what's the payment look like with 20% down, and how much cash do you have to bring in at closing, and how much does that leave you with? What's it look like at 15%? What's it look like at 10%? And one of those numbers are going to speak to you, and you're going to go, that's the one I'm comfortable with.
God, good stuff. All right, I'm trying to find something I can answer here, but you're just doing such a solid, job that I don't
Well,
want to get in the middle here.
the reason why I was so demanding and asking you to answer the question is that COVID makes you tired, bro. So, of course, all of the questions would come
Uh,
my way today. I'm like,
that's
let's
good.
get something for Jeb. Let's get Jeb to talk for a while.
Look, Jennifer Lego just gave you the 411. She's interrupting, giving her money to tell you to hit the like button. Out of control, you Jennifer. But thank you. So hit the like button, guys. Help us get to 200 likes. That's a long way. We're at 170. We got 40 minutes, and that's a lot of likes to get there. I don't know if we're going to have it but that'll be our most that we've ever had on a live in that period of time, though. Anyway, let's see here. So I said this one earlier, and now I can't say it. Guacali. I don't know. I was told that the county might need to reassess the property and increase the property taxes on 50% of the new value.
Swapping out one owner. It's
Got you. I was trying to figure out.
possible. It's
Right.
possible. It can happen. So depending on where you're at and what exclusions may exist. So I'm going to assume you're in California, because in the other 49 states, they get reassessed every year based off of what the home values do. We have Prop 13 that protects us from that. There are parent to child exclusions, parent to grandchild exclusions. And if I remember correctly, we were talking about brother and sister in this situation. So you could be reassessed. So depending on what the home is currently assessed at and what the home is worth now, you are correct. That could trigger a reassessment, and you would want to be careful with that.
All right, there you go. Drama Addict has a question here. For a first-time home buyer looking for a home as an investment and to stay for a few years, do you think getting a condominium is a better choice or a house? And then goes on to basically talk about HOA fees, which I'll click on here in a minute. What I would say is a first-time home buyer, don't think of your property as an investment. Find something that you're okay living in. And I know a lot of people out there are trying to think, 2 to 3 years out that they want to buy something, get into the market, sell it, make money, move on, buy something else. Try to get you out of that mindset. Now it seems crazy, right? But try to think more long term. I think too many people buy for what fits their needs right at the moment without thinking where their life's going to be 2, 3, 5, 7 years from now, right? I mean, as you might be a single person, you're thinking, hey, listen, I can live in a studio or a small condo or whatever, but maybe you're engaged, maybe you're planning on having kids, maybe whatever. So if you're starting thinking of it from an investment standpoint too early on, I don't think you'll make the right decisions. I think you need to think of a property as where you could see yourself living for the next 5, 7 years at least, especially in the environment that we're in now where prices have increased. Not that, again, I'm not here telling you that you're going to see this huge, massive shift in the market and change in prices or any of that, but you don't know really what the future holds. So you got to come in with the idea that you're going to hold that property for 5, 7 years, you're comfortable with the payment, you have money in the bank. And if the opportunity presents itself in a couple of years to turn that into an investment property or to sell it and buy something else, then so be it. But don't go in from the mindset, if you don't even own a home up front, and think of your first property as an investment property. At least that's how I look at it. But you go on to talk about HOA fees and seeing areas bloom around it like Microsoft, Facebook, Google are building their offices. Buying a property in an area that's appreciating, where businesses are coming in, where there's job growth, where there's job stability, are all really good things for buying a property, whether it's an investment property or something you're going to live in. Those are good things. And you're talking about Atlanta, and I know Atlanta is one of those markets that's been booming for quite some time. So in buying a condo over a single family, you've got to decide what's right for you. I mean, I have some clients that say, I would never live in a single family. And you got people on the other side that say, I don't want the maintenance of a single family home. There's pros and cons to both. You just have to decide what's right for you in this situation, right? I mean, if you're somebody that travels a lot, or somebody that is never home and whatever, then maybe a condo works for you. But if you're somebody that has dogs and kids and multiple cars and that sort of thing, a lot of times the condo life doesn't work for that type of life situation. So just, you got to weigh the pros and cons on your side. And again, I would venture to tell you to think a little bit further out than going in as an investment right to start with. Hopefully the opportunity presents itself. You can turn it into an investment, and it cash flows and all that good stuff. But Josh, what would you add on that?
Not a whole lot. It really just comes down to you personally. Some people despise the idea of living in a common interest development like a condo. Other people despise the idea of being responsible for their own front yard and putting a roof on the house when the time comes. A condo is a great way of being able to own your home without having all of the responsibilities of home ownership. But for some people, that sounds awful and they don't like that. So know yourself would be the most important thing. And then exactly what Jeb said, for most people, I want you to have a 5+ year time horizon before you think about buying. I am a real estate professional. I have different insights into the market, and I would probably be comfortable buying with a shorter time horizon. But for most people, I really think it is important to have a 5+ year time horizon if you're thinking about buying and owning a home, just because of the transaction costs on the way in and out are pretty significant.
No, and here's the reality is I would have told you the same thing 5 years ago or 7 years ago. I mean, it's that 5 to 7 year time horizon is not going to change in my eyes. I think you've got to go in with that mindset. And if you know that you need to move in 2 years or 3 years because whatever reason, a job transfer or whatever it is, you have this plan, then maybe buying a property is not the right thing for you to do at this time, right? You've got to factor all of that in. You can't have the expectations that the market's going to continue to do what it has done over the last couple of years and you're going to be fine. Hopefully it does. But you need to think longer term horizon. And that's coming from somebody that thinks about, no further than what's going to happen 6 hours from now, versus, somebody. I don't do planning, people.
What Jeb is really trying to say is he is quite possibly the most impatient person in the history of the world. And if he has to wait more than 6 seconds to do anything, his head explodes.
There's a lot of truth to that, people.
There's a lot of truth to that.
There's a lot of truth. Yeah. My wife would get on here and just badger me if I told her I planned any further out than like a day. Anyway, MG has a question here. How often can you cash out refinance, Josh?
In simple terms, as often as you like. You're going to hit a wall pretty quickly of not wanting to pay costs and run out of equity to keep pulling out of the home. But you can do it as often as you would like.
All right. Easy answer. My dualor, maybe. Does that all go together and make something? I don't know. Anyway, is it true that as a neighborhood becomes more developed and the house values become higher in that area, property taxes go up along with it? Yeah. In a lot of states, absolutely. The state of California, not so much. I mean, your property taxes can increase no more than 2% per year. But in areas, some of these areas like Texas and some of these other areas, they do these reassessments. Typically, I think it's about every 2 years. And depending on the growth in that area, what's happened, you can get a big reassessment on your property taxes. So regardless of whether you want to look at it as an area becomes, a neighborhood becomes more developed or whatever, it's just in general, as properties increase in value, whether it's just that neighborhood or around it, chances are the property taxes are going to go up in a lot of areas outside of California because they don't have the Prop 13 that we do here in the state of California.
I'm jealous of because she has the cool spokesmodel, like over the shoulder look. If I tried to do a headshot like that, I would look like the biggest idiot on the planet, but she looks like a pro.
We should get those done.
Yeah.
Like, I can't even do it here.
Yeah, they would. Our pictures would end up looking like when Step Brothers, when they did their family portrait. That would be the two of us.
Like this?
Yeah.
Yeah. Anyway. Here we go. I'm gonna let you hit a home run here, Josh. Is it better going with a loan broker or the bank you are established with for your first home loan?
So the only time, and people think that there's some benefit to working with their bank. The only benefit is going to be if you are in a part of the country where there's local community banks, you can have a relationship with them and they can look at something, uniquely in your favor based off of your long-term relationship. If you're in Southern California, you bank at Chase Bank, there is zero benefit of going with Chase or B of A or Wells or any of these other big lenders. When you call in, they're going to route you to a call center. You're going to talk to someone that's a glorified bank teller. You're not going to get a lot of expertise, and you're not going to get great terms because that's not what they specialize in. So in terms of a broker or even a direct lender that specializes that just does mortgages, either of those, you're more likely to get connected with an expert who can help you guide you to the best loan terms for you. I'm biased. Jeb's told you guys 1,000 times I'm a broker. The benefit of being a broker is I can shop every lender under the sun. The reality is we don't. I have about 20 lenders that we work with on a regular basis, and we're shopping there to get you as close to the best terms as possible with as close to the absolute best service as possible so that we can make sure you're smiling and happy at the end of the transaction and give us one of those 5-star Google reviews Jeb was talking about.
No, absolutely. Good response there. And dancing along with alone with rentals rather, is saying my mug belongs on a milk carton. Yeah, there's a lot of truth to that. Sonia is got a question here. I don't know if I pronounced that. Oh no, there's an L at the end there.
I think it's also in LA.
There's no L at the beginning.
Also in LA.
Oh, well, I get it. Okay. Also,
they just didn't capitalize it right.
All right. Well, hey, maybe. Who knows? Anyway, they're thinking about refinancing a home they bought 2 years ago, but looking to buy a second house in the near future. Is there a period of time that you would have to wait after refinancing one to buy another house?
No, but it depends on how you're trying to structure this. If you're looking to buy the second home as your new primary residence and keep the departing residence as a rental, you can have a problem because we use something called the mortgage electronic registration system. So if you refi your home and you say you're doing it owner occupied because you live in it right now and you want to get the best terms, and then 2 months from now you go to get a new loan and you want to say you're owner occupying that also, the lender's going to look like, well, just 2 months ago you were looking at you refinanced your home owner occupied. So it's something to be aware of. There is no hard and fast rule on it. It just has to make sense to the new lender, your explanation as to why you didn't know 2 months or 3 months or 4 months ago that you were not truly going to owner occupy that home for the duration of that refinance. So no limitation. If you're thinking about doing it, do it sooner rather than later. And if you're thinking of staying in your home and buying the new one as a rental, no problem whatsoever on that in terms of the timing.
All right. We got a lot of refinance questions, man. There must be a lot of people looking to refinance. I saw a stat the other day, they said like 15 million people still at in a position where they could refinance and actually save money.
And that's for people that it's just a matter of getting you a lower interest rate and a lower monthly payment. The bigger thing that we're seeing is more and more cash out refinances. And I think, and I look back, I have several clients that bought up in LA when home prices were really cheap. They paid $250,000 for their house, and it was a 50-year-old house that had some deferred maintenance. Now the house is worth $600,000. We can get them $50,000, $60,000, $70,000 to do the renovations. The other thing we're seeing a lot of is, I don't love this when someone's got overextended on their credit, but being able to consolidate debt. When we're consolidating debt, I like to have a plan going forward. How are we going to prevent the debt from accumulating? Can we shorten the term? Can we go from a 30-year to a 20-year, pay off the debt? You still have less cash outflow every month, but sort of meeting an objective of getting debt-free going forward. But you're 100% correct. There's still a ton of people in the current market that can benefit from refinancing, and it's important that they get with a professional and don't call a call center that's just trying to sell them on a refinance, and go through the actual numbers and determine, does a refinance make sense and what's the optimal way to structure it.
No, good stuff. So to follow up to that, Jason had a question here and asked, is there any way to cash out more than 80% of the value of the home?
There are options.
I want to do a 110.
They're going to be ugly, and you can't go to 110. They're going to be ugly in terms of the terms. Probably the best way to keep the terms reasonable is to do an 80% first mortgage cash out and then concurrently close a second for another 10 or 15% of your home equity. And I say that, Jason didn't mention being a veteran. Veterans can go to 90 or 100% on a VA loan. Every lender will do 90. Every lender I'm aware of will do 90%. There are still lenders that will do 100% cash out on a VA loan.
All right, there you go. I'm reading a question here, and I'm baffled with the actual question. If you bought a house with 2 mortgages before the house crash in the 2000s and haven't made a single payment on the small mortgage from the past 15 years, will it affect when selling the home?
So she's asking. Yep.
Okay.
They bought a home with a first and a second mortgage.
Okay.
So they've been living there, making payments on the first. They stopped making payments on the second. This is really common, not uncommon at all.
I got you. Okay.
So they weren't making payments on the second, but now if you want to go to sell, the second didn't go away. The lender chose not to make any collection effort, but they have been accruing interest and penalties through that time frame. We have a lady that I believe came from the show here out in the Palm Springs area with this exact situation, and the loan was like a $15,000 loan initially, and it's $59,000 that they owe right now. So it's still a lien against the property. It's going to show up on title. You will not be able to sell that property without satisfying that lien.
All right, there you go. No, yeah, I guess I didn't understand about the single payment not making a mortgage, but now it makes sense. Good. So good job, Josh.
Well, here Maria follows up with, I was told it will go away. It won't. It's not magic. If you filed bankruptcy and you filed a Chapter 13, you could have had the second lien stripped from the property. But if you didn't file bankruptcy and if you didn't do it the right way back then, there's no magic. It's not going away. You borrowed money from them, secured by the real estate, which you still own, and you will be repaying them when you go to sell. Your best bet is to reach out to them and see if they will negotiate a payoff for a lesser amount than they're owed. That's most likely to be successful if that loan has been sold. Most of those second mortgages that were underwater back in the day got sold for pennies on the dollar, and sometimes those lenders can, give you a big discount and still make a nice return on their money. But if they want to be a hard ass, now that there's equity in the home, they can just say, nope, pay me my money.
Right. Fool. Anyway, Golden Gate's asking if I looked at the rules. I completely forgot. I will make a note here in just a minute and I will look at that. So sorry, bear with me. I'll get back to you. My mind wasn't here last week, as I mentioned earlier in the video. So one stock, 2 SS. I have enough for a down payment, 3.5% and 6 months of expenses. Should I still apply for a mortgage even if I don't have closing cost funds? And what I would say, yes, it's not going to hurt you to apply to see where you stand. Maybe you're in a position where the lender can give you a slightly higher interest rate and actually give you a credit towards those closing costs back through the loan. That there's a chance there. Maybe you're in a market where, maybe if inventory is increased enough, you might be able to get the seller to pay some of those closing costs. The key here that you said, though, is you get 6 months of expenses on the sidelines. If you're going to not have the money for closing costs, and you're going to try to get someone else to pay for them, keep that money aside just in case, so you have some reserves. But I say there's an opportunity there, especially from the lender, to be able to give you a potential credit to help offset those closing costs. So that might get you in the game. But having that conversation is the first step, and you can see exactly where you stand. And once you have those numbers, you can determine whether there's anything in your market that actually meets what you're looking for in a home. And maybe the numbers, maybe you qualify for, exactly what you're looking for. Maybe you don't, and you need to, work on saving a little bit more money so that you can get where you need to be, or what have you. So run the numbers. Again, Josh would say the numbers don't lie. And then from there, make a determination, have that conversation with that lender, if you will, and see if there's a potential for them to help you out with those closing costs.
To circle back to the last question, do I go to a bank? Do I go to a broker? with a 3.5% down, and we're probably talking about FHA. One of the benefits of FHA is we can get big lender credits. We help probably a client one a month, with covering all of their closing costs and all of their prepaid. So all they come in with is that 3.5% down payment. I saw an article yesterday with a number that kind of boggled my mind. We get questions on here occasionally. Why won't anyone take my offer with my Quicken pre-approval letter? Or why do people tell me not to use Quicken? The article was talking about gain on sale. So Quicken's public now. Rocket Mortgage is public now, and they have to publish what their gain on sale is when they sell a loan into the secondary market. So on their wholesale loans, they do wholesale loans. If I wanted to, if I was so inclined, I could place your loan with Rocket. On those wholesale loans they do, their gain on sale was like 130 basis points. So 1.3% of the loan amount was what their profit was. Now on their retail loans, their gain on sale was 489 basis points, almost 5%. So that tells you why you don't want to go to Rocket or another direct lender, because their margins, their interest rates are high. They're making a ton of money on those loans, and they don't have the ability to give you a large lender credit. So for the most part in California, you're going to need 1.5 to 2.5% lender credit to cover your closing costs, to cover all of your closing costs. And we're able to do that on the broker side. Retail lenders, the margins, their interest rates are higher, their margins are higher, and they don't have the ability to cover those closing costs for you. So in this instance, I would absolutely say reach out to a broker, see what they can do in terms of doing a loan and covering your closing costs for you.
Yeah, and if you decided to put that loan with Rocket, UWM wouldn't do business with you anymore, Josh. So you'd be screwed.
You have to be all in.
Yeah, you got to pick one or the other, and that's no. People are like, "What the hell is he talking about?"
But again, that same article also had UWM, because UWM is also now public. Their gain on sale was like 120 something basis points. So again, we do loans with Quicken or with UWM. We don't do a ton of them, but the reason why is those margins are much more palatable. We can get our clients a better deal, give them bigger lender credits.
Right. No, good stuff. Let's see here. Let's find something. We had a lot of good questions tonight, guys. So we've kept Josh busy. He wasn't even sure he was going to come, and he's been talking for like an hour and a half straight.
I'm worn out. I'm going straight to bed when we're done. No kidding.
So let's do this. Let's talk about interest rates for a moment. We always do that. So let's talk. What have we seen in the market with regards to rates? Changes from last week. Predictions.
Almost no movement from last week, and right now we're sort of in a sideways trend. My belief longer term is definitely still, and when I say longer term, just later on in the fall, I think rates will continue to trend lower. I don't think we're going significantly lower. So if a refinance makes sense right now, by all means, take advantage of where we're at. From day to day, we see rates up, rates down. The minutes from the last Fed meeting were supposed to be released today. They were about 3 minutes late, and the market sold off because they were convinced that meant something tragic was happening. And then Fed released their minutes, and rates went right back to where they were 3 minutes before. So a little volatility from day to day, but we're really in a sideways trend. I wouldn't expect them to be much better or much worse. We're locking all of our clients immediately right now, just because we don't see a lot of gain. If we're going to close your loan in 14 to 21 days, not a whole lot on the horizon that should lead us to believe that rates are going to be better, and we can just take the uncertainty and stress out of not being locked. So with that being said, FHA rates, VA rates still in the low 2s, 2.25 with 0 points for the best qualified borrowers. Conventional can be a little bit all over the place just because of different loan to value, but for the most part, safely down into the 2s for every borrower. So rates are awesome right now. If it makes sense to buy, if it makes sense to refinance, you're going to get really good terms.
All right. Ego Eats. How often can you get investment home loans, Josh?
It's not so much how often as how many. So Fannie and Freddie will limit you to 10. So once you get to 10 financed properties, you're not going to be able to go the Fannie Freddie route anymore. But takes a while to get there. So after 4, they start getting more restrictive, but they'll go all the way up to 10.
Yeah, I can speak to that. Back when I did loans, I had a client that owned like 75 properties at the time, and this guy had maxed out his 10 with every single like he had 10 with Wells Fargo. At the time, it might have been less actually. It might have been like 4 or 5 with each bank. And I remember at the time, the Scotsman's Guide, right, had all these lenders in it, these non-QM type lenders. We go out and try to find somebody, and at the end of the day, because loans got sold and whatever, he ended up with a ton with like Chase. And I'm assuming, because I wasn't doing loans there at the end of that, when everything changed in market, he probably went to the bank and negotiated every single one of those things down to you know substantially. And they probably, because of the potential hit of how many properties he owned, probably cut some of the mortgages on those, and values came back up, and he's probably doing fairly well, but it's hard to say. But yeah, there is a limit. And once you have the 10, it's difficult to find lenders that'll do it.
And there's two different limits there. Fannie and Freddie literally have a limit that will limit you from going to any lender and doing a loan that's going to get sold to Fannie or Freddie. But then every lender has their own requirements of maximum exposure they'll have to one borrower, and most of them it's about 4, even at that. So even though you could go get 10 loans right away, they're probably not going to go to one lender. You're going to have to split them up to a couple different lenders.
No, absolutely. Evelyn had a question here a moment ago. She says, so I want to buy a house. My credit's 715. I have a $45,000 down payment. First time homeowner. 2 people telling her that she can't get anything. What can you do? Really want to buy. So instead of, I'm assuming the 2 people telling you that you can't do anything are lenders. And if that's the case, then if you've got 2 people telling you that, then maybe, that's the case. But at the same time, they should be telling you what you can do in order to maybe to help with that. Is it income? Is it debt? Like what's the situation that's preventing you from buying? Now, if it's your neighbor and your friend telling you that, then I would tell you to talk to a lender, right? Have them look at your credit, have them look at your debt, have them look at your credit scores, and tell you exactly how much you can purchase. Maybe it's not at the value that you want to purchase, but at least gives you something to work towards. And you're not going to be able to know without having that conversation. So that's where I would start. But if you've been turned down by lenders, maybe reach back out to them and say, why can't I qualify? And they should be able to tell you if it's based on debt or you just don't make enough income or what have you. So, Josh, anything you want to add to that?
Yeah, we have a fancy way of saying exactly what Jeb just said, is I don't ever tell anyone no. The answer is never no, but it might be not now. And if it's not now, what has to change so that you're able to buy in the future? So if it was 2 lenders and they just said, hey, sorry, you can't do anything, they should tell you exactly what Jeb said, which is, hey, we need to get your bigger down payment. We need to get a longer employment history. We need to make some more income. We need a co-borrower. It should be as simple as saying, hey, the pieces that we're talking about here, 715 credit score and a $45,000 down payment, there's a lot of context there that we don't know. Are homes in your neighborhood $200,000 or are they $700,000? How much do you make? How much do you feel you can afford? Like, you would be surprised how often I have people come to me and say, okay, here's what I got, I want to buy. And I go, cool, you can afford $300,000. Like, oh no, homes are $600,000 in my neighborhood. Like, okay, well, how much do you feel you can afford in terms of a monthly payment? Oh, I can do $1,600 in a monthly payment. So would you realize that on a $600,000 purchase with 3% down, the payment's a lot higher than that? Oh, I didn't know. So there's nothing wrong with not knowing, but the person that you're talking to should be able to walk you through this, explain to you, here's what a payment looks like on the homes that you can buy in your neighborhood where you'd be comfortable living. Here's how much you need to have in terms of dollars. Here's how much you need to make in terms of income, so that at least you know where you're missing and what gap you need to cross.
No, good. Golden Gate has a question here. Hearing the market is not as overheated with multiple offers. What are you seeing for existing home sales? Will this cause prices to go down finally? So we talked a little bit about this at the beginning. I'm seeing I haven't written an offer where there hasn't been a multiple offer situation yet. And I say yet, and I'm talking about the last however long, right? I don't remember when the last time I wrote an offer where there wasn't some sort of multiple offer situation. So, Yes, it's probably calmed down from where it was 6 months ago, but there's still, buyers out there looking, and when the right property presents itself, it typically has multiple offers, especially in certain price points. In California, in especially in Southern California, it's hard to find a property at this point, especially a single family home under, and this is going to sound crazy to many people, under $750,000, $800,000. There's just not a lot of them here in Orange County, Southern California, even Long Beach, where I am. So when you have properties in North Long Beach and some of these markets come on the market and they're priced $600,000 to $650,000, it's going to have multiple offers just because there's a lot of people that have been pushed out. And I say pushed, they've chosen to go outside of the market that they were maybe initially interested in and go to some of these markets where they can actually get a single family home versus a condo. And therefore demand is still very, very high. But affordability starts to play a part in that, right? So as you get, homes that are pushing $800,000, $900,000. I mean, here in Orange County, our median home price for the month of July was $1,080,000. Josh talked about at the beginning, there's willing demand and there's able demand. There's a lot of people willing to pay $1 million for a property because, they like the property, whatever. How many people are actually able to do that is a different question. So as values, if they do continue to go sideways to up, you're going to lose some buyers just because they're not able to afford that. Now, I do think you have a better opportunity to purchase now than you did a couple of months ago, just because I think there is a little bit more inventory. I don't know if it's less buyer demand or just people tired of going through the process. And so instead of having 20 offers on a property, maybe you only have a couple. I talked at the beginning, a lot of these properties in North Long Beach, 29, 30 offers on a property. And these are examples I have from my own experience. Just put offers in for a couple viewers here on the channel in Rancho Santa Margarita. Every single one of those had multiple offers too. And that's a $700 and something $1,000 price point for an attached home. So yes, I do think things will slow, but I don't know that it's really going to translate into what a lot of people want to see. I think it just translates into a little bit easier maybe to get that property versus, a couple of months ago when maybe you didn't have a chance at all just because of how fast things were moving. I also talked about an example of a property here I had in my market that sat on the market for 25 days. Any buyer out there was probably looking at it going, it's overpriced. It needs to be reduced and I might be a buyer. Well, day 22, 23, we received 2 offers. It ended up selling slightly above the asking price. So there's still demand out there. It's just finding, the right buyer and what have you. So, the seasonality of the market is going to take hold here soon. And what I mean by that is, we talk about real estate being a cycle every year. 2020 was a bit different because of the wrench thrown in it with stay-at-home orders and the shift in the house work environment and that sort of thing. So let's take 2020 out of it. But typically you have a spring market, you have a summer market, you kind of have a fall and a winter market. And that doesn't matter where you are in the US, you have some variation of that. But what I think here is as you move in, kids are back into school, most kids here in Southern California, things are going to slow a little bit because parents that just put their kids in a school don't want to have to change district. They don't want to have to do certain things that they might have to do in order to move their kids around. Also, you got, summer vacations are over. People are getting back in the work mode. You're going to have the holiday season coming up sooner than many people. It's not going to happen sooner than you think, but it's going to happen quickly, right? Just because time moves by and gets away from us. And I think with that, you're going to have some seasonal slowdown. And I think the headlines are going to read the housing market's slowing. And maybe to some extent it is, but I don't think it's going to be for the same reasons that people are portraying it as that. So yeah, go ahead.
Just a little bit ago, or a couple hours ago, when we first started here, you said, "Hey, the month-on-month figures came out 5% increases." So it made me think. I said, "What happens a couple months down the line when it's a 0.5% month-over-month increase?" The headlines are going to say, "Market shifts into down shifts to a really slowing market."
Right.
There will be some crazy headlines, but think about that. 5% is insanity. That's, you annualize that, it's 60%. Home values aren't going to go up 60%. But at a 0.5% a month, that's 6% annually. So What we should be hoping to see and expecting to see is like 0.1, 0.2, 0.3% month over month. That leaves us somewhere in the 3 to 5% annual increases. So stop looking at the headlines and look at what the numbers are saying. Anything more than 0.5% a month is an incredibly hot market month over month. 0.1, 0.2, 0.3% month over month is a very healthy and appreciating market. And I don't think we're going to see anything other than that for the foreseeable future.
No, absolutely. I agree. And you know, there's further questions on here asking about moratoriums ending and that sort of thing. I personally don't think that's going to have a big change on the market. I've been talking about that for a year and a half. There's too much intervention. There's too many ways to help people exit that in a way that's not going to affect, you know, the value of their home per se, if they did decide to sell and or they decided to keep it. I mean, there's a lot of opportunities to keep things kind of moving in the direction that they're moving, and therefore I don't think that's going to play into to the direction that, you know, over the next couple of months to even years. I just think there's still a lot of money on the sidelines and a lot of people willing and able to purchase a property if prices were to come back down, and maybe if there were more inventory, which I think is a big driver.
If you are not yet convinced that the government is not going to allow the housing market to suffer, you haven't been paying attention for the last year and a half.
No,
they are
absolutely
not going to allow it to happen.
No, absolutely. I'd like to ask a favor though. We're pushing 2 hours here. There's 233 people on. If everybody liked this video, it would get us to 200 likes. You know, it's not a lot to ask. All you got to do is push the button. Just push it. You know, we've never had it before. You know,
you've never got a like before.
Never. I've got it, but it's superficial. They don't really mean it. So anyway, a lot of people are asking for my contact information, asking for Josh's contact information. You can get it there. Do us a favor though. If you have questions about the housing market, real estate agents, you need an agent, you need a lender, reach out. We're happy to put you in touch with somebody that can help guide you in the right direction. Doesn't matter where you are in the US, we are able to connect you and make sure you're in good hands. A lot of you reach out all the time and tell us the success stories. I should do something with all of that at some point to show you how many people actually take advantage, and not to toot our own horns, because we're not doing anything other than connecting professionals with good clients with good professionals. But at the end of the day, it's rewarding, and it makes us being here worth it. So with that said, Josh, anything you want to add? You want people to say a prayer for your health here?
Just yeah, so that I'm not so sleepy and feeling better. I'm serious though. I will say everyone I know that's had this has had a much worse time of it than me, so it hasn't been bad. But I am tired of being sleepy and groggy and not feeling great. So if we can feel great next Wednesday for you guys, it would be awesome.
Next Wednesday, am I here next Wednesday? I'm here next Wednesday. The following Wednesday, I'm one last trip. Where are you
going?
Going to Yosemite.
You covered wagon, or what are you doing?
Covered wagon. Yeah, that's the plan. Now I'm going to take a little vacation before the kids go back to school. So my kids aren't back in school quite yet. They go right after Labor Day. But we're going to do one last family vacation and get to another national park. We did Zion last year. It was awesome. We had a good time. And Yosemite looks like a good place to go. So we're going to go do it.
All right. Sounds good to me.
But we got some time. We got 2 weeks, people. But we appreciate you being here. As always, appreciate the support. If you have a question, comment, leave it below. Hit the like button, and we will see you again soon. Have a great day. Adios. Bye-bye.
Yeah.